Welcome to the New Wealth Wave podcast hosted by Dr. Joaquin Wallace. We're diving deep into the intricate layers of the 7-stage generational wealth model to offer invaluable insights on legacy building, wealth accumulation and preservation, and financial growth across generations. I'm Dr. Joaquin Wallace, and this is the New Wealth Wave podcast. Hey, future wealth builders. Welcome to another episode of the New Wealth Wave podcast. I am your host, Dr. Joaquin Wallace. And today our focus will be the state of affairs within our current economy, where market sentiment is running amok. To help lead the discussion will be James Alexander, who is a certified financial planner, partner at Edge Financial Advisors, and co-host of Ed's Edge. We know that we have a lot of turmoil in the market itself, and James is uniquely skilled at helping families navigate this uncharted path that we're on today. James first came on earlier this year, and he said, you know what, I want to come back. And I said, we're going to bring you back 60 to 90 days within the current administration to talk about the issues or what's going on today. And we know that there's a lot of panic going on today. James, as you know, we have an enormous amount of animal spirits rearing their ugly heads in the market. James, welcome back.
Thank you so much for having me. You know, Dr. Wallace, when we started talking about this and coming back 60 and 90 days in, we talked about, there will be some change. And I don't think you or I thought there would be this much in this short order. So looking forward to the conversation.
If this is your first time tapping into the New Wealth Wave podcast, it's based on my 7-stage generational wealth model. The model focuses on 3 phases, the past, present, and the future, broken down into 7 stages. So let's get into it. Stage 1 is our internal and external ecosystem, walls in and walls out. It sets the foundation for our financial journey. Stage 2, financial genetic code, where we focus on financial trauma and anxieties. Both are byproducts of stage 1. Both of these stages are related to our past. Stage 3, financial healing. This is where we begin the healing process, reprogramming our financial genetic code, which is a byproduct of both stages 1 and 2. Stage 4, financial edification. This is where we focus on both financial literacy and financial inclusion. And today, James and I will be talking about stage 4, 5, probably some 1 and 2 as well. But stage 3 and 4 are the present. Stage 5 is financial well-being. We all want to achieve this, focusing on not outliving our income. We want to have a soft landing in stage 5. Stage 6, generational knowledge. This stage provides us with the blueprint to properly transfer our knowledge and assets to create our financial footprints, which leads us to stage 7, generational wealth. Stages 5, 6, and 7 can be regarded as our future. However, depending on your entry on the model, your present is the stage that you are currently entering. Now, James, this is your second time on the podcast, so make sure you go back and take a look at the first time James was on the podcast itself. So, James, you had a chance to look at the model. What was your initial thoughts?
First and foremost, I think it is so well laid out in terms of learning who we are in that first chapter, how we grew up, what shapes our beliefs and our values, and using that to then educate ourselves around some of the pitfalls that we have given our foundation. And that then in turn gets us into how can we better improve our overall well-being, let alone the financial well-being, which is that stage 5, 6, and 7 you talked about as we get to there. So very enlightened I was by how you laid that out, and I've used it with my clients. So I appreciate the insight there.
Appreciate that. So let's get into it because there's a lot that I want to uncover today. So one of the first questions that I want to ask you, there is a significant difference between systemic risk and non-systemic risk. So for our listeners, what is the difference between the two? And can you properly prepare for both in terms of financial planning?
Wonderful question to kick things off. So systemic risk in a nutshell is the risk of the overall market itself having problems, right? Having issues in the economic landscape. It's more of a macro outlook on society and economic growth and the risks associated with that, the volatility. Unsystemic risk, for that matter, is more granular. So it talks about risks of different areas of the market. For example, technology, utilities, individual stocks even. We've seen what happened with Tesla, things of that nature that also has risks that's different than market risk. For example, a CEO passes away, the whole company might be restructured, or tariffs affecting certain areas of the market. That is those unsystemic risks, not the macro, not the overall outlook, but they're tied together in some way, shape, or form. And so how do you protect that? Well, one of the easy answers is to diversify, not put all your eggs in one basket, have a horse in every race, whatever phrase we want to use for that. But that helps with the unsystemic risk. How do we help with the systemic risk? That comes back to very sound financial planning, is making sure that I have enough safe money for immediate income needs, making sure I understand my time frame for things, making sure I understand the probabilities of returns over time, despite the variability with what's going on. There's a lot to that. But in short, diversify and then know your own financial game is how I would answer that question.
That's a great answer to that question. So let's get into another hot topic. You ready for this one?
I'm ready.
Okay, here we go. Explain to our listeners in layman terms what tariffs are and how directly they affect the consumer.
Absolutely. It's a hot topic, right? So very simple way to explain tariffs to me. We all kind of know it's a tax, but how does it work? So if I'm America and I'm going to pick on Ford, I'm going to use an example to explain. I'm going to pick on Ford, and Ford needs to produce cars and they need parts to produce cars, one of them being metal. I find that in overseas, wherever it may be, the metal is cheaper there. So I want to import it into the US so I can lower my costs. And let's say it's $100. I'm using a round number for metal. With tariffs now, if I import it from overseas, I might be paying a 25% tax on that metal. And so now instead of it costing me $100, it's costing me as a business $125. Where does that $25 go? It does not go to the country that exported it over to us. It goes to the United States government, right? So that's one of the common misconceptions, is the other countries are not benefiting from this. In fact, they're being detrimented, probably because less people are going to do business with them if the other country has to pay more. But going back to Ford, if I'm paying $125 when I used to be paying $100, now I'm thinking to myself, okay, I might have to charge more because I still need to make a profit and I need to keep my business going. And so that's the concerns in the macro about what's going on with tariffs and all the back and forth that we're hearing.
So that's where we have, again, the animal spirits. We have a lot of irrational decision-making by investors, panicking, so to speak, and we're going to get into those as well. So what is the state of the union right now, and how does it impact the economy, market, and portfolios?
I'll do my best to answer this simply. The State of the Union, there's certainly a lot of uncertainty. No one would argue with that. Consumer sentiment is something that I want to go to first, because consumer sentiment is how do we feel about the state of the economy and the stock market, regardless of the reality, right? How do we feel about it? And the most interesting stat came out about a month ago. If you voted Republican, in this case Trump, but you're a historical Republican, consumer sentiment, even a month ago, has gone up in terms of positivity. There's optimism from that because of our natural belief system. If you voted Democrat, it went significantly down because of your belief system and everything else. And so depending on who you talk to, some people are saying things are great, things are not. The reality is there's a lot of uncertainty. Now, within that uncertainty, we still have a strong economic foundation. I probably won't get into that today, but what's happening is all this back and forth of, the Trump administration trying to change things is what the market isn't liking because it doesn't know where to go. And that's creating the volatile nature that we're experiencing. So hopefully that answered your question. I can expand upon that, but I know we don't have a ton of time. There's a lot more that I'm sure we'll talk about as it relates to that.
Yeah, and we're going to come back again another 90 days for the check-in with Mr. Alexander as well. So, why is the market behaving the way it is based on the changes and the power of uncertainty? How does the market work versus how the economy works?
This is so foundational to understand, is the stock market versus the economy. The economy is a snapshot in time. For example, what is the unemployment rate? How are jobs doing? What is earnings across the board? It's a snapshot in time, fixed point. The stock market is forward looking. It doesn't care about today. It cares about tomorrow. By tomorrow, I mean 1, 2, 3 years from now. And so what the stock market always tries to do is look at what the future will be. And it's a probability game. If something happens, that means a probability of this will occur and we don't like that, so we're going to dip down. And it's ever evolving on that. And that's how the stock market works. It's a pricing game for the future versus the economic landscape is fixed in nature. And so while they're correlated, they're not exactly the same. That I think is really foundational when it comes to investing. Why we talk about, money you need today. Stock market is not the way to go. There's too many uncertainties that could happen along the way.
That's a great answer. So how can we best separate fact from fiction in all we hear? Negative news versus positive news versus reality.
Positive news, I'm going to go back to that consumer sentiment. If you're optimistic about what's going on, I want to go back to something I think we briefly touched on in the former episode we did together. One is, if I believe in the Trump administration, I think everything that they're doing is phenomenal, I'm going to search it and I'm going to go on my iPhone and I'm going to search all the positive things that are happening. And my iPhone is smart. It has AI built into it. It wants to send me things that I'm going to keep reading so it can sell me ads. So it will keep sending me on the Apple News and everything else. It'll send me more positive things, confirming my beliefs, making me think these are all true and nothing else is problematic. Same will happen on the opposite side. And this sells more. If I'm fearful of certain things, I'm going to search it. And the Apple product will be able to send me things to confirm that. And why I bring this up to answer that question about positive versus negative versus reality is we become so biased around either end, depending on where we think. The reality is the economy is still in good shape overall. Is it in great shape? No. But is it in good shape? I would argue yes. And we can talk about lots of data points that most people don't care about, but our investment team talks about it plenty. That said, the stock market hates uncertainty more than it hates bad news. That is huge. It doesn't know where to go. And so I remember this from COVID times. Is the economy going to shut down? Are people going to die? What does that mean for all these programs? That uncertainty created a lot of volatility until we realized, okay, there's a lot of bad news going on, but now at least we know and we can settle and take action based on that. And so that's the state that we're in. That's the fact of the matter, is we still have a healthy economy, but the Trump administration is trying to change some policies and they're being aggressive with it. And that's the uncertainty that's going on, is what are they going to be able to change? What are they not? So I think taking it in stride and controlling what you can control, which we'll talk about, is massive to address that.
That's a great answer to the question because, again, the economy is in great shape. But again, you have a lot of panic, a lot of loss aversion, people becoming risk averse. All of those are good to an extent, but for the most part, now is the time. If you're going to get into the market, today is the day you want to get in. So next question for you. When should we decide to de-risk our portfolios, personal time frame versus market concerns?
The time to de-risk is when something changes in our life that should force us to de-risk, and force not necessarily in a bad way. But I'm going to take a step back and say, if we are buying things and if this environment right now is scaring us too much, we probably shouldn't have bought it in the first place if we've lost sight of our actual goals. So we need to have a foundational structure of our investment portfolio, regardless of market times, to account for time frame. For example, if I have 10, 15, 20 years out before I need some of this money I'm going to invest, you can take a lot of risk compared to if I need the money in 5 years. And so I want to show this chart here where a lot of people think, okay, is the stock market really like a casino? And they think, oh, it's just gambling. You're back and forth. And this year is starting to confirm that in our mind, right? So if you see there on the left-hand side, those of you watching on YouTube, we talk about the odds of winning in an actual casino, right? And none of them are over 50%. I do not like those odds. The houses will win. They didn't build themselves in Las Vegas. But you look on the right-hand side and you look at the average percentage 1 year time frame when the market is actually positive, it's 73%. That's greater than 50%, but it's still not guaranteed. And so if I need the money in 1 year, I probably shouldn't be buying stocks because there's a 27% chance I'm going to lose money. We don't want to invest. But you take a look at 3 years, 5 years, the longer out we go, here's the 10-year, 97% chance that the stock market will be positive. In all environments, this is going back to the Great Depression era. This is going back to World War II. This is going back to the 87 crash, the housing market crash. This data is all aggregated in there. So when should I de-risk? I should de-risk when something in my personal life changes to change that time frame. Under the condition I have a sound portfolio. It should not be due to market fluctuations. That should be a second point, not the first point. So,
when you talk about that, that's one of the conversations that you have with a lot of clients. I know you have it. I have it as well. But oftentimes, one of the things that I try to get across with my clients is that you have to be patient. And again, I like what you said. It depends on where you're at. The financial planning model, if you're 28 to 45, you're looking at the accumulation phase. If you're 45 to 60, you're looking at the preservation of capital phase. From 60 on, you're looking at the retirement and gifting phase. But the closer you get to the 60, that's when you have to be a little bit more mindful in regards to where you're at. But one problem I know that you have, and I speak to my clients, is that many of us go poor safely. We're really not willing to take on the risk, but in essence, you have to take on some risk to outperform inflation, which is difficult for many because they think that, this is going to happen. The Great Depression, Enron stock, or you're talking about the housing bubble that burst. All of these things, yes, those things can happen. But again, that's understanding systemic versus non-systemic risk. Some things you can diversify against, some things that you can't.
That's so well said. I completely agree with you. And especially that retirement phase, making sure you have an ample amount of income covered for a longer period of time. If I have 7 years worth of my retirement income needs met safely in safe things, then I need to have that 7-year mindset of, do I believe the growth-oriented things that I still need for my 70s and 80s, do I believe that it will come back in that period of time? And the odds are good on that.
Absolutely. So how can we remain calm in a world of uncertainty?
Oh, that is such a loaded question and a wonderful one to ask. How do we remain calm? I always start my clients with, first and foremost, understanding what we can control and understanding what we can't control and being at peace with what we cannot control, which I understand is hard. But this other slide I want to show, it's a visual that talks about, when you're investing overall for the long term, what can you control? You have complete control over your spending and your saving. You have complete control over asset mix and risk and all of that. And you also have control over your legacy. And so we want to focus on those things. What you have some control on are, amount of taxes you pay. You can't change the tax code, but there's some strategies there. Employment earnings, how long you work, things of that nature. You have some control there. But this is the piece that creates so much fear that I've experienced with my clients, is really what we can't control. Can I do anything about government policy right now? Right? I'm not in Congress. I'm not working with the administration. I don't have any control over that. I have to be at peace with that aspect and focus on what matters to me, instead of looking too much at the outside world. And then market returns, right? We know the market over time will do well, but we don't know exactly when these things will happen. It's news driven right now. And I just have to be at peace with that. What we tell a lot of our clients on the market side of things is this is the price to pay for long-term growth. And if we're not willing to pay it, we need to have a deeper conversation as to why, because this will happen again. I can tell you that. So anyways, it's all about the controllables in my mind.
I love that you have to be able to control the controllables. It's like modern portfolio theory basically suggests diversification, right? You want to make the most money that you can with the least amount of risk. That's what everybody wants. Well, they want to make a ton of money, but the least amount of risk. And as I said earlier, oftentimes or not, we're going broke safely, because when we have to make that decision, no, I don't want to do that. I'm going to go into fixed incomes. I'm going to go into bonds. I'm going to go into CDs, or I'm just going to leave it in the bank, or I'm going to put it under my mattress, because eventually, I'm concerned what's going to happen over the long term. But again, I want to make the most money I can with the least amount of risk.
Yes, I love the way you put that, going broke safely. That's so well said.
Future Wealth Builders, please find us on Apple, YouTube, Spotify, and all major social media platforms. Today, we're thrilled to welcome James Alexander, a certified financial planner, partner at Edge Financial Advisors, and the co-host of Ed's Edge. So another round of questions for you. How has recent market volatility influenced investor confidence, and what are behavioral biases?
I'm going to start with the behavioral biases, and then I'll talk about the volatility and how it affects the confidence, because I think that's probably the best way to go here. So great question. Behavioral biases, we have our own world that we live in. We grew up a certain way. That's what you talk about in the stages 1, 2, and 3. We need to understand how we grew up, which shapes the way we think. And so the way we think might be, taxes are a terrible thing and the government shouldn't be involved in anything. Or we might think, government is a really good checks and balances and everything else. My humble opinion, I'm going to use an analogy on that. A balance is good. And so when you're driving through something, you don't want to have 25 stop signs to go 1 mile. That's too much regulation. You also don't want to have a free-form highway going 100 miles an hour. That's too dangerous. And so nonetheless, we believe certain things, and therefore we think that's the way everything needs to work. And I'm going to steal a Mark Twain quote where he says, "It's not what you don't know that gets you into trouble. It's what you think you know that isn't so." And so we have these biases of this is how it's supposed to be. And really, we don't know how everything syncs up together, and it's very hard to. But those behavioral biases are going to shift to, if the market's down and I'm thinking to myself, oh, it's his fault. Did this happen? And this happened. And I'm starting to get all emotional, which clouds my logic brain. And logic is huge when it comes to investing. The people who, to your point earlier, you said can stay patient and use logic. The old adage, buy low, sell high. You go to the grocery store. I'm not going to pick on eggs because that's a sore topic right now. So I'll pick on a pair of pants at Target. If I go on Target and it's $20 and it's the same pair of pants and now it's $15, it's on sale. I want to buy that. It's a similar concept for long-term investors with the market. And so those are the people that win in this game. And they always will, as long as we believe in the global growth of America. But what's happening is we're in the now mode, and it's hard to be patient. And so we're seeing things go down. And those that tell us, oh, everything's going to be fine, we sound like we're just salesmen, right? Just stay the course, everything's going to be fine. Those that say the sky is falling and want to help you, it's going to drive our attention. We're going to feel like, oh, they're trying to solve a problem. I want to divert from fear. I'm feeling afraid right now because this is my money and I'm losing it. And I'm saying it in that way because that's causing anxiety because of how we're ingrained as humans, especially based on our belief system. I can go on and on about this topic, but that in and of itself is why people have this fear and this aspect of, I need to do something. And often you don't within your portfolio. You don't need to do certain things as long as you have the right mix of investments for you, not for your neighbor, for you.
That's interesting because when you look at the model itself, you can navigate back and forwards. So let's say hypothetically that person that we're speaking of is in stage 5. They're in their financial well-being. Something has happened. A financial flashpoint has occurred. So they go right back, as you mentioned earlier, to stage 2, that financial trauma and anxiety. But that may be a byproduct of stage 1, where they may have grew up in a scarcity of resources. And so now they're going back and forwards within the model itself. But as you stated earlier, if you just have the strong foundation and understand that in the long run, the market always corrects itself. It always does well. But again, we're in the moment. We're a prisoner of the moment at that time. And that's why it works well when you look at the model itself, because it doesn't matter where your entry point is. You're constantly navigating back and forwards the stages of the model, because eventually we want to get to that soft landing, but something has happened. I go right back to my stage 2, have this trauma and this anxiety, which is a byproduct of something occurring when I grew up, my walls in, my walls out. In stage 1, analysis by paralysis, so to speak, that's not allowing me to move forward. That's a great point. So in an era of rising inflation, how are consumer spending habits shifting? And what does this reveal about our financial decisions?
What people are realizing now is if things are going to cost more based on tariffs, let's say they stay in place for a long period of time and things are going to cost more, I need to rework, my priorities around my budget and what I'm spending. And I'm going to talk about 2 things. It's a little bit of an economic education here, but there's elastic services and inelastic services or products. Elastic products are things that I want, and they're often a little bit more luxurious. For example, the BMW instead of the Honda. I don't need them, but I'm striving for something there. The inelastic products and services, if tariffs stay in place, I think these are going to win out a lot more because people are going to go back to the basics. They might shop at Aldi or Walmart to just get my foundation in place instead of going back to, I want to go on a vacation or something that I don't necessarily need. So I think that consumer behavior will shift more to protecting the fort. That's speculation on my part. We're not there yet, but it's sounding like that'll happen if tariffs stay in place and costs go up. And I think we just need to go back to having a sound budget of what do I actually feel at peace with? We spend a lot of money subconsciously. And I think people are starting to realize not a lot of that's bringing me joy anyways. Why am I spending that money? I don't want to go on the cup of coffee example, but there's lots of times we're just like, oh, what's for dinner? Let's just stop something real quick and pick it up. And they spend $20 more and don't think about it. Right? As opposed to, I have ham and turkey in the fridge. That's fine. It's going to taste fine. It's free. So little things like that, I think people are going to become more aware of that as we move forward.
I love that disposable versus discretionary, needs
Yeah.
versus wants. I mean, that is so important. I mean, that's basically Maslow's 5 hierarchy of needs, right? You have your innate
Yeah.
needs, and then as you move up, you get the social environment. Those are your wants. I have those conversations all the time with my clients. You have to understand needs versus wants. And, I say, hey, listen, live today, plan for tomorrow. You have to enjoy your life today. But I always say, you may live 15 or 20 years, so you always have to plan for tomorrow. But again, I love that disposable versus discretionary, needs versus wants. So, with the rise of AI driven investing, I know you're going to like this question. How does automation impact human decision making in the financial markets?
We do know for a fact what AI is doing and is making the markets react faster than ever before. In 80s and 90s, you'd have to call your broker and find out if you got the stock 3 hours later. Now it's happening on a dime. And it's not just technology, it's AI. And the reason I'm saying the market's moving faster is, you've got human behavior that's driving some of the supply and demand with markets. And then you have hedge funds and institutional money, which are these big corporations driving markets. But then you have algorithms that are figuring it all out and trying to optimize. So it's swinging faster than we've ever seen before. Does that matter in the long run? No, it does not matter in the long run. In the short run, it's scary because we're moving faster. But that's really what the major impact of AI is in the markets today. One very exciting part I wanted to share about AI when it comes to productivity and gross domestic product. I know we don't want to get into that too much, but gross domestic product is the output of our economy. And AI is allowing us to have less workers for the same to more productivity, because at first hand, I'll share what I used to be able to do in 10 minutes, I now can do in 10 seconds due to AI. And that is something that I think will continue to happen. And so that's what's exciting about economic growth is we're going to be able to produce more at a much faster rate than we ever had in the past. And so I want to provide a little hint of positivity despite all the uncertainty that we got going on.
I totally agree. I was just talking to someone a couple of days ago, and I said, you have to embrace AI. You can't fight it. You have to embrace it. There is some good with it as well. We're getting some economic teaching. We're getting some behavioral theory. We're getting some modern portfolio theory, some EMH. I mean, we're getting it all right here on the episode itself. This should really suit a lot of individuals who tap into this one. They're going to be able to cover all the gamuts. So how might psychological factors influence home buyers and real estate investors as the housing market cools?
I personally think that the housing market cooling is going to create some optimism for young buyers. What I mean by young buyers is primarily millennials. They've been priced out of housing market, generally speaking, relative to their wages. The housing market has gone up significantly higher than people have been able to earn on an income level. And so we're becoming house poor if we start taking action and don't run our numbers. As the housing market starts to cool, I think a lot of millennials will jump in there and be able to afford some of these things. Now, at the same time, baby boomers who have decided, I'm not moving. I got a 3% interest rate. My home is already paid off. I don't want to downsize quite yet. I got a good thing going. They might be rethinking that as we move forward. And so I think there's going to be a shift more towards millennials owning more and more homes despite this cooling market because they're on the buy side. At the same time, we talk about home builders and real estate agents and all that. That's a whole nother can of worms. They're going to be hurt a little bit from this. But as long as it cools and doesn't get bitter cold, I think we'll be okay. My 2 cents.
So in the face of economic uncertainty, why do people continue to invest heavily in speculative assets like cryptocurrency and meme stocks?
My take on that is get rich quick. It's exciting. It's sexy. FOMO, right? That's another aspect. Fear of missing out. My neighbor's doing it. My buddies that I'm having beers with are talking about it. All of that. And I don't want to feel like the person left behind because it's the next craze. And that is a fool's errand. I'm not saying that those investments are going to be terrible in the long run, but speaking of uncertainty, there's too much of that going on there that we are over speculating and gambling unnecessarily. And we don't know enough about that foundation to be able to put a lot of our money into it confidently. That's our take on it. When I listen to Warren Buffett and one of the best gurus of our world, and he said, if he had $1,000, he wouldn't even touch it because it's not backed by anything, talking about crypto and all that. That's a sign. Now, it doesn't mean you can't time things right, but let's not mistake the perfect timing for brilliance at the same time. Let's be humble about it all. So yeah, getting rich quick, there's no such thing. I'm sorry to say.
You're talking about that herd mentality then.
That's right. It still comes back to us.
Still comes back to us. Future Wealth Builders, please find us on Apple, YouTube, Spotify, and all major social media platforms. Today, we're thrilled to welcome James Alexander, a certified planner, partner at Edge Financial Advisors, and the co-host of Ed's Edge. So the final set of questions for you. As we wrap up, what is the key message that you want the viewers to take away from this particular podcast?
I would start with educate yourself on what's going on without trying to have too much anxiety about it. I know that's hard to do, but be aware of our environment so you can understand the actual impact. But more importantly than that, the biggest takeaway I want people to have is control what you can control, focus on your game, your own financial game, laser focused, and set up yourself well, regardless of what's happening outside.
And before we let you go, tell us about any upcoming projects or initiatives you're excited about. What's next for you?
What's next for me? I am, speaking of behavioral finance, I'll be getting another designation there probably soon. I'm thinking sometime later this year, early next year. I'm very passionate about that. We also added an associate advisor to myself. So I'm trying to expand out my team so I can help as many people in this world who have stress and have a team surrounding me, like-minded individuals, to be able to do that. And that's frankly what I'm most excited about, is just sharing information that I've been able to learn with others. It's the name of the game.
So, you know what? I'm going to ask one more question. So why do you believe in this market that, having a behavioral background is equally as important as having a financial background?
Such a wonderful question, because we're human is the short answer. I'm dealing with humans here. I'm not dealing with robots and computer systems and algorithms, when we talk about what to do. If I was, I wouldn't need that, because we have an input and we have an output. And that's all we need to do. But along the way, there's human elements. And that's what makes us such an enjoyable job for me, is without that, people wouldn't really need me. Without that human element, they wouldn't need me. Someone to talk through certain things on their mind and understand factors and get who they are. That, I think, is where my value lies more than what I know, is to being able to understand them and create ideas, creative options that make sense for them, but still have a foundational element to it as well. So honestly, also to stay relevant as we move forward within this new age.
When I got my certification in behavioral finance theory, that probably was the most significant certification that I received. Because again, you look at it from a humanistic aspect. Great, the finance, we know 1 + 1 is 2. We know all of that. But there's a lot of human behavior that decides where we're going to go. And it's based upon, obviously, our stage 1, 2, and 3. But once I was able to understand that, it gave me more tools in the toolbox, because now I'm able to meet the client where they're at versus where I think they should be. So, I agree with you. I think that all financial planners should have some sort of certification or just education in regards to how the behavioral finance theory comes into play when we're meeting with our clients. If someone wanted to get in contact with you, how would they gain your services?
I can be found directly on our website at Edge, F as in Frank, A as in Apple.com. My contact number is there along with my email. So we'll certainly send a link for that. I appreciate you asking. Or our podcast as well, where we seek to educate. That's Ed's Edge. You can find that on the website also.
Sounds good. And you are going to come back in the third quarter, right?
That's right. If you'll have me, Dr. Wallace, I'd love to.
No, listen, every quarter we need to have you come on to kind of recap the last quarter. Right? I think that's so important.
I'm sure there'll be no shortage of news.
Absolutely. Something else will happen. We have to come back in the start of October, the third quarter of July, to kind of get into what's going on, right? Having to last in the second quarter. James, thanks for coming on. On behalf of the New Wealth Wave podcast, my producer, Ray Haycraft, I would like to thank James Alexander, a certified financial planner, partner at Edge Financial Advisors, and the co-host of Ed's Edge, coming on this afternoon. And as we always say, generational wealth begins with generational knowledge. I'll see you on the next episode of the New Wealth Wave podcast. Thank you for joining us on the New Wealth Wave podcast, hosted by Dr. Joaquin Wallace. Our show is edited and produced by Ray Haycraft. To dive deeper into the world of financial wisdom and learn how to create your financial footprints, head to our website at www.drjwallace.com. For more updates and exclusive content, connect with us on social media by searching Dr. Joaquin Wallace. And if you have questions and comments, feel free to email us at thenewwealthwaypodcast@gmail.com. Remember, generational wealth begins with generational knowledge. And as always, thanks for listening. The content presented in this podcast is strictly for educational purposes and should not be taken as investment advice. The views and opinions expressed by our guests may not necessarily reflect those of the New Wealth Way podcast and its host or producers. Listeners are urged to exercise discretion and judgment before making any financial or investment decisions. Always consult with a financial professional or advisor before taking any action based on the content of this podcast. If you're enjoying the New Wealth Way podcast, we appreciate if you leave us a review. We're always open to topic suggestions and guest recommendations. Feel free to reach out to us directly with your thoughts and feedback. Thank you for tuning in, and we'll see you next time on the New Wealth Way podcast.